Hello and welcome to this session. This is Professor Farhat. In this session, we would look at share-based payment. This topic is covered in International Accounting course, the CPA exam, as well the ACCA exam. Please connect with me on LinkedIn if you haven't done so. YouTube is where you would need to subscribe. This is my channel. I have over 1,500 plus accounting, auditing, and tax lectures. Please like my lectures if you like them, share them, put them in playlist, let the world know about them. If they're benefiting you, it means they might benefit other people. Share the wealth. This is my Instagram account. As I'm trying to grow my Instagram, please follow me on Instagram. This is my Facebook, and this is my website. On my website, if you like the channel, you would like to support the channel, I do have a donation button. Please feel free to support the channel. Also on my website, you can find offers for my subscribers. Right now, Becker CPA Review is offering $1,000 off of their Becker Bundle CPA exam, which is the gold standard in CPA preparation, all 4 parts of the exam. Also, you will have unlimited access. As long as you need it, you will have access to it, that's very unusual that Becker does give this option, but it is available now. Also, if you are not studying for your CPA exam now, if you are still a college student, Becker CPA prep course would allow you to supplement your college studies with thousands of multiple choice questions, exercises, and simulations, as well as hundreds of hours by Becker faculty lectures. Let's talk about share-based payment, which is covered in IFRS 2. Let's look at the big picture first. What is the big picture? The big picture is when the company, let's assume this is the company, the entity. When the company wants to purchase something, they pay cash. So we'll give cash and we'll buy what we need to buy. And the other party provide their goods or services. That's generally speaking how transactions are settled. Guess what? Sometime rather than giving cash, maybe we don't have cash, maybe we have cash, we'd like to preserve the cash, we want to pay with some sort of an equity instrument. Give them stocks. Give them stock appreciation right. Give stock options to our employees. So this is what we are dealing with here. So rather than paying with cash for goods and services, we're going to be paying with some sort of an equity instrument. So IFRS 2, which is the share-based payment, sets out measurement principle, how do we measure the transaction, and specific requirement for the 3 types of share-based payment transaction. The first one is equity settled share-based payment transaction. What is equity settled? It means the entity received the goods or services as a consideration for equity instrument of the entity, including stock options granted to employee. Simply put, we receive the goods, we give something other than cash. So we don't give cash, we give something other than cash. We could give stock options. For example, we can pay our employees with stock option. Another form of share-based payment is cash-settled share-based transaction. Notice this is equity settled. It means you're going to pay them actually with equity. Here, you're going to pay them with cash. Now, the cash is based on some equity measurement. So basically, entity acquired goods or services by incurring liabilities to the supplier. Obviously, yes, we incur a liability of those goods or services for the amount that are based on the price of the entity shares or other equity of the entity, which is share appreciation right. Simply put, you'll tell them, I'm going to pay you based on my stock price. So I'm going to give you 100 share appreciation right, 100 shares. And depending how much the share is, when the time is due, I will pay you. If the share is $5, I will have to end up paying you $500. Okay, that's the second option. The third share-based payment plan is a choice of share-based payment. What does that mean? It means you could either settle it in cash or you can settle it in equity. So terms of the arrangement provide either the entity or the supplier. So either the entity can choose the form of the payment or the supplier, with the choice whether the entity settle the transaction in cash or issuing stock. So simply put, the entity can have that option, or the supplier can have that option. And what's the option? So we have the entity here, the company, and the entity said we're going to settle it in cash, or we're going to settle this in equity. Or that option is given to the supplier, and the supplier says, I want to be paid in cash, or the supplier say, I'm going to settle it in equity. Okay? So, and we're going to look at each one of those, 1, 2, 3 in detail. That's the purpose of the lesson, but this is just an introduction. So IFRS 2 applies to share-based transaction with both employees and non-employees and require the entity to recognize all share-based transaction in its financial statements, no exception. Simply put, The share-based transaction, they could be between you and your employees or between you and outside party, non-employees. We're going to be using the fair value approach. What does it mean, the fair value? It means we're going to be recording the transaction based on the fair value. Now, in some situation, we're going to be using these transactions are recognized at the fair value of the goods and services obtained. In another situation, we're going to base the fair value on the equity of the instrument awarded or granted. So simply put, what does that mean? So sometime, and we're going to look at each situation separately, sometime we use, this is the equity instrument. Sometime we look at the equity instrument, the fair value of the equity instrument, and we record the transaction based on the fair value of the equity instrument. Other times, in other situation, we're going to look at the situation differently. We're going to look at the fair value of what we received, and that's going to be the fair value of the transaction. Let's go ahead and get started. We have a list. We're going to start with number 1. Equity settled share-based transaction. This is one of 3. One of the 3 we're going to be covering. Okay. So again, this is share-based payment transaction entered into by an entity that will be settled by the entities issuing equity are accounted for as equity transaction. Typically, what do we do is we debit either an asset or an expense, depending on what we provided. So simply put, we debit an expense or asset, depending what we obtained, and we credit some sort of paid in capital and common stock. This is basically what it boils down to. So we issued stocks for something, either an expense or an asset. Okay. Now we have to differentiate when we have those. We're going to differentiate between when we have equity settled share-based payment to employees and to non-employees. So we have to know, are we dealing with employees? It's treated differently than when we deal with non-employees. Okay. So the next thing we're going to do, we're going to break section 1 into whether this share-based payment to a non-employee. We're going to start with non-employee. Think of non-employee as creditors. They don't have to be creditors. Anyone that's not an employee is non-employee. I'm just going to think of it as creditors. This way you are familiar with, like, okay, I'm buying goods and services from my creditors, from my suppliers. Okay? Suppliers, not creditors. Suppliers, I meant to say. So you measure the transaction at the fair value of the goods received. That's the first thing you have to know. What does that mean? It means you are dealing with non-employees. You would look at the goods that they gave you, and you're going to use the fair value of those goods. Usually that's given. If the fair value of those goods cannot be determined, then the fair value of the equity instrument is used. So if the fair value of the goods that they're selling you, we cannot determine the fair value, then what we do is we use our fair value. One of them should be known. Okay? So if the fair value of the instrument is used, of the equity instrument is used, the measurement date, so when do we measure it, is the date the entity obtained the goods or the service. So when do we record the transaction? Well, we're going to look at when did we obtain the goods or the services, at what day? And based on that date will be the value of the transaction. If the goods or services are received on a number of dates over a period, so we received some goods here, some goods here, some goods here at different date. So it's going to be 1/15, 2/3, 2/15. Okay? Guess what? We're going to, for this transaction, we're going to figure out what's the fair value of the instrument on that date, what's the fair value of the instrument on that date, what's the fair value of the instrument on that date. So it's pretty straightforward. Now under US GAAP, so let me just show you how US GAAP work. Under US GAAP, we always start with the fair value of the instrument. So if we're giving equity to someone, we always say the value of the transaction is the value of our equity. Now, if we don't know the value of our equity, then we would look at the other party. But notice here, with the non-employee, we look at the other party fair value. Okay? So the seller, the earlier of either the date at which a commitment for the performance is reached or when the performance is completed is used as a measurement date for determining the fair value of the instrument. So this is under GAAP, when the date that we measure the instrument. Okay? So this is important. Now we're going to look at share-based payment to employees. So again, share-based payment, but employees are treated a little bit differently. It's measured at the fair value of the equity instrument on the grant date. So notice now we are giving stock options to our employees. What is the employee giving us back? Well, services. They're working for the company. When we measure the transaction, we use the equity instrument, just like US GAAP does. Okay, so the entity issuing stock option must estimate the number of options expected to vest. What does that mean? It means we might be giving them 1,000 options, but they don't all vest. It means we may end up vesting 600. Why? Because some employees leave. Maybe the options are not worth anything. So we have to know how much are they giving them and how much do we expect the vest to actually materialize. Okay. The product of the number of options expected to vest multiplied by the fair value is the total compensation cost that will be recognized over the compensation expense. Simply put, if we're giving them 1,000 options and we expect the fair value of these options to be $10, so we have a compensation expense of 10,000. Now, when do we recognize those compensation expense? Over the vesting period. Let's assume the vesting period is 2 years. We're going to use the straight line for simplicity. We're going to recognize 5,000 of expense and 5,000 expense. Now, maybe I should define what a stock option is because I'm just throwing this word out. What is a stock option? Let's assume you are hired by Amazon. Let's assume you are hired for Amazon. Amazon might give you stock options. What is stock options? For example, Amazon might say, I'm going to give you 1,000 options to buy the stock at $2,500. Okay, the stock right now is approximately $1,700. Okay, so what is the option worth? It's worth 0. It's not worth anything. Why? Because the price right now is just $1,700. Why would you buy the stock price at $2,500 if you can buy it at $1,700? But what's the goal of the options? The goal of the option is if you work for the company and you work hard, you drive the stock price up more than $2,500, and for every dollar above $2,500, you make $1,000 profit. So that's how the stock options work. So the company will have to estimate how many options will be exercised times the fair value of those options, and this is going to be the total compensation expense. Okay, cost should be revised throughout the vesting period with corresponding adjustment to compensation expense. So what happens sometime, some employees leave, so what's going to happen, compensation expense will go down. As compensation expense is recognized, it's offset by an increase in additional paid-in capital. What does that mean? It means when you recognize stock options, you're going to debit an expense initially, and you're going to credit capital or an equity account. Simply put, an equity account goes up because you credited capital. Expense is an equity account. That's going to go down. You might be saying, that doesn't make any sense. Yes, it does. Simply put, you are showing the expense on the income statement, although the overall equity is the same because you recorded an expense and you offset it with capital, but you still have to show it. I know it doesn't make any sense because there is really no expense to the company until you exercise. That's the truth. Because if you never exercise, if they gave you those options and the stock price never went above $2,500, it's like a tree falling into the forest. No one cares. Nothing happened. Nevertheless, you still have to debit an expense. You record an expense and you credit a capital. So it does hit your income statement, but at the same time, you increase your equity. Okay. Now, how would you expense the options? You have two options. You could use a straight line, which I showed you earlier, or you could use straight line, or you can amortize the expense, the compensation expense, in tranches. That means in pieces, same as US GAAP. Most of the time we use the straight line method. When I teach it, I always teach it using the straight line method. Now, if you are looking for this and just like, I need more about stock options, go to my chapter 16, Intermediate Accounting, and you have a whole thing about stock options in case you felt this is not enough for me about stock options. Okay, let's take a look at an example to see how this works. Let's assume a corporation grants stock options with a fair value of $100,000. Grant means they give their employees the option to buy, and the value of this option is $100,000. Okay, how did we come up with $100,000? It's given to you. They told you it's worth $100,000. 50% vest at the end of year 1 and 50% at the end of year 2. In other words, you have to work 2 years for this company. Under IFRS, compensation cost associated with the first tranche is fully allocated to expense in year 1. So simply put, we have 100,000, 50%, and 50%. That's the vesting. Under IFRS, for year 1, we're gonna vest this 100%, and we're gonna vest 50% of year 2. Okay, 50% of year 2. As a result, the amount of compensation expense in year 1 is $75,000, which is $50,000 plus 50% of year 2. Half 50,000 times 50%. And the amount of compensation expense to be recognized in year 2 is $25,000. So year 1, we're going to debit expense $75,000, credit equity or capital $75,000. Year 2, the expense is debited $25,000 and capital is credited $25,000. Okay, The same pattern of compensation recognition would be acceptable under US GAAP, which is you could use this for US GAAP, or under US GAAP we can go ahead and use the straight line and expense 50,000 and 50,000. Okay, let's take a look now at the cash settled share-based transaction. Now they are cash settled. Remember, cash settled means when we settle them, and this is the second type of share-based. We've been talking about equity-based. Now we're going to settle it using cash. So rather than issuing stocks, we're going to go ahead and give you cash. Okay, so here's what happened. An entity might provide employee with stock appreciation right in which they are entitled to receive cash payment when the entity stock price increase above a predetermined level. What does that mean? It means they will tell you, right now the stock price is $20. That's the current price. They will tell you, if the stock price reaches $30, guess what? We're going to give you a value of 100 shares. Simply put, you have $3,000 in your pocket. Okay, so they're not going to give you 100 shares. They are not going to give you 100 shares. They're going to give you $3,000 in cash. That's what they're going to give you. Okay, so this type of transaction would result in the recognition of a liability. Why? Because they have to pay you cash. They don't have to issue stocks for you, and it'd be an expense. We'll debit an expense, credit the liability. How is the liability measured? It's measured at the fair value of the share appreciation right using an option pricing model. Simply put, option pricing model means AKA in accounting, given to you. It's going to be given to you. We don't have to worry about this. So, and it means sometimes the option pricing model goes up, sometimes it goes down, and you have to adjust that liability up or down. Under US GAAP, we're going to look at how we treat it under US GAAP. Until the liability is settled, it must be remeasured at each balance sheet date with the change reflected in net income. So, remember I told you $3,000. If the stock price go to $40, now I owe you $4,000. Well, I owe you more. I have an additional $1,000. Under US GAAP, certain cash-settled share-based transactions are classified as equity. These transactions must be classified liability under IFRS. So under US GAAP, they say what you're doing is really, this is an equity transaction. Under IFRS, it says this is a liability. The third type of settlement is the choice of settlement. Okay? Either you can, choice of settlement, it means you could either get it in cash or get it in stocks or equity. Allow the entity to choose between equity settlement and cash settlement. So you could either get, once it's mature, once it's due, you could either settle it in equity or settle it in cash. Give them cash or give them equity. Okay, the entity must treat the transaction as a cash settled share-based payment if it only has a present obligation to settle in cash. If it has to be settled in cash, then it becomes a cash. Otherwise, the entity will treat it as an equity transaction. Okay, so simply put, they'll decide. Now, assuming this is the entity deciding. Now, when the terms of the share-based transaction allow the supplier, now the supplier decides. The supplier tells you, I want it to be settled in cash or I want it to be settled in equity. Okay? When they have the allowed to choose, when they are allowed to choose between equity settlement or cash settlement, the entity has issued a compound financial statement, not a financial statement, a compound financial instrument. In other words, we have two financial instruments. We have a debt and we have equity. So now we account for the transaction as two instruments. We owe them money, which is debt, and we could also owe them equity. Okay. The debt component, how do we determine the debt component? The debt component must be remeasured at fair value at each balance sheet date with the change in fair value reflected in net income. So the debt value could go up, the debt value could go down. We have to report that gain or loss in net income. If the supplier of services and goods choose to receive settlement in cash, the cash payment is applied against the debt component. Obviously, that means I have to settle it in cash. So I'll have to pay you cash. This is how it's going to be settled. The equity component remain in equity. If the supplier chooses to receive settlement in equity, the debt is transferred to equity. Basically, we remove the debt, we debit the debt, and we credit equity. The best way to illustrate this is to actually work an example. Let's take a look at this example to see how this all works together. So we have a company on January 1st issued 100 stock options with an exercise price of 18 to 5 employees, which is in total 500 options. What does that mean? It means the employees, they can buy the stock at any time at $18. So if you receive those options, you can buy the stock at 18, which is you're going to have to pay $1,800, but you can buy it at 18 whether the price is $50 or the price is $100. Okay, so you're giving them the option to buy it. Now, the employee can choose to settle the option either in shares of stock, so they can get the shares, or they can settle it in cash. And cash means they would receive cash. And the cash value would equal to the intrinsic value of the option on the vesting date. Now, what is the intrinsic value? Remember, you can buy the exercise price. This is the exercise price is 18. This option is worthless to you unless the stock price is above 18. If the stock price is 15, this option is worthless. It means it's worth nothing. Why? Because I can buy the stock at 15. Why would I pay 18? When is this option worth something to you? When it's above 18. If the stock is 25, guess what? The difference between the exercise and the current price is $7. This is called the intrinsic value. This is the intrinsic value of the stock. Now the stock is worth something, intrinsic value. The intrinsic value is $7. So you can either settle it in intrinsic value or you can buy the stock at $18. The option vests on December 2nd, year 2, after the employees has completed 2 years of service. So when do you qualify? You have to put 2 years worth of service for you to be able to exercise it. Now the company will recognize the expense over 2 years. Okay, but you have to wait 2 years in order to be able to exercise. So one employee resigned in year 1. One employee resigned in year 1, and the company continued to assume an overall forfeiture rate of 20%. So the company expect only 4 employees would remain, because if you don't put the 2 years, simply put, for you to get the options, you have to work year 1, you have to work year 2. After you put those 2 years worth of work, remember we had 5 employees. After you put those 2 years, the option will vest. Guess what? One of the employees left, so we have 4 employees now. Okay? Because if you leave before you put the time, you don't get the options. So when they give you the options, you have to make sure you're aware of the date. You're aware of the vesting date. The vesting date means after that date, you can exercise the options. As expected, 4 employees vest on December 31st, year 2, and the exercise and their stock options, obviously they all vested. The share price and the fair value is as follow. So here's what happened. When we granted the options, the share price was 20. The fair value of the cash settlement consideration alternative is 10. December 31st, year 1, the share price was 26. The fair value cash settlement alternative is 12. In other words, we'll give you $12 if it vests today. December 31st, the share price is 30, and the fair value of the cash settlement is 12. And this is perfect because, you can buy it for 30. The option is 18, so you'll have $12. So this is like perfect value. Okay. Now the question is, how much would the company incur an expense? Because remember, the company granted those options, granted 500 options to their employees, and each option they can buy at $18. However, the fair value of the stock option will not be known, until the end of the year. So at the end of the year, we have to figure out what's the fair value cash settlement. In other words, if we have to settle this option today, and this will be given. What we're saying is the fair value is $11. If we have to settle it today, the fair value is $11. We're not going to settle it. Okay? But if we have to do it, we have to pay $11. Well, okay. If we have to pay $11 and we have 500 options, well, we have $5,500 in cost. Now we're assuming how many? We're assuming all 500 options are exercised, but that's not true. We're only 80%, because one employee left. We expect one employee to leave, whether they left or not, but this is what we can assume. So basically what we're going to have to do is we only have an expense of $4,400 as of the end of year 1. At the end of the year 1, we have $4,400. Now we're going to take this $4,400 and spread it over 2 years. So every year we're going to create an expense of $2,200. So let's see. So this is the computation that I just made. Then we're going to debit compensation expense for $2,200. We're going to credit share-based payment liability $2,200. Now under US GAAP, we usually credit capital, but this is how do we do it under IFRS. So year 1, this is the entry for year 1. We recognize $2,000 of expense and $2,200 of liability. Now again, for US GAAP, we have credited some sort of a capital account. some sort of a capital account. Okay? I told you earlier we offset it to capital. Under IFRS, we offset to liability. At December 31st, year one, the fair value of each option equal to $12, which is the share price was $30. The exercise price is $18. It means right now, any employee can make $12 from this trade. Okay? Now you might be saying, why was it 12 year one? How did you compute this? It's given to you. It's given to you. But year two, once it vests, now you could just compare the share price to the exercise price. So the fair value of the liability, if we have $12 intrinsic value times 500 option, that's $6,000. But remember, we're only going to get 80% of the $6,000. We're responsible for 80%. Therefore, the expense is $4,800. Okay? So the amount to be recognized as compensation expense in year two is $4,800 in total for the whole option, minus we recognize $2,200. So we have to recognize $2,600. Simply put, we debit compensation expense $2,600, credit share-based liability $2,600. You might be saying, why didn't we go $2,200 year one, $2,200 year two? What happened is the stock price went up. The stock price, let me show you. The stock price went from 26. The stock price went from 26 to 30. So the stock price went up. As the stock price went up, the fair value of the cash settlement went up. It means we have more expenses. In year one, we had $2,200, but the value of the option in year two becomes in total $4,800, of which we recognize $2,200 in year one. So we have to recognize the remaining, which is $2,600 in year two. So this is what we do before they actually come to exercise. In other words, before the executives comes to exercise. Now we're going to look at the exercise. So this is what the company, so this is year one, compensation expense for the company. This is year two. So the company already recorded their expense. Okay? Now let's see what's going to happen when the executives come to the company and they ask for the cash or they want to exercise their option. Okay? Accounting for exercise for the stock option under the two settlement alternative is as follows. The first thing we're going to look at is cash settlement. And let's look at the cash settlement. Simply put, the cash settlement, remember, we already recorded share payment based liability. Let me just do this on the previous slide so this way you can see it. Share payment based liability. $2,200, $2,600. Well, guess what? If we need to reduce this liability, we have to debit this liability, $4,800, to make it go down to zero and credit cash. So the cash settlement is pretty easy. We debit the share-based liability, share payment, I should say share-based liability, $4,800, we credit cash $4,800. Now, the executives, they may not want the cash, they want to settle it in equity. In other words, they want to buy the stock. Well, if they want to buy the stock, they have to pay money, they have to pay cash. How much cash will they have to pay? Well, there are 400 options. They have to pay $18 in cash. So they have to pay the company $7,200. We'll debit cash $7,200. Then we have to remove this share-based liability. So we're going to debit share payment based liability $4,800. This stock has a par value of 1, therefore we credit common stock $400. And anything left is APIC or paid in capital, which is $11,600. So this is if the transaction was settled in equity. Simply put, the executives will have to pay us cash. We remove the liability that we created as we were recording the expense. We credit common stock and we credit additional paid in capital. Why did we credit common stock 400? It's the number of shares. This is how much you credit common stock times the par value. And anything left, this is a plug figure. Now, under US GAAP, once again, under US GAAP, we will not have a liability. We will not have this account. We have an equity account. We will have an equity account. Okay? we will have an equity account. Remember, US GAAP will have equity account. We'll consider this as equity transaction. IFRS will consider it a liability transaction. So simply put, let me clarify one point, because I kind of spoke about earlier here. Let me just I just want to make sure. Okay, as compensation expense is recognized, it's offset by an additional paid in capital. This is US GAAP. Okay, all right. If you have any questions, any comments about this topic, please email me. If you happen to visit my website for additional lectures, please consider donating. If you're studying for your CPA exam, as always, study hard. It's worth it. Good luck, and see you on the other side of success.